Let me invite the man who's gathered us here, Emmanuel Alex Asiedu, who's the one who runs Stanlib in Ghana, to give us some context by way of welcome remarks and introduction. So please put your hands together for him.
Distinguished guests, ladies and gentlemen, good morning. When we set it upon ourselves to have this program, Stanlib Dialogues, a number of high finance sounding topics came to mind. One of them was the relevance of pensions in our industry. The other was environmentally sound investment strategies. George, you are here. But then somebody whispered to us that our industry is in the midst of a storm. And when you're in the midst of a storm, you don't think about tomorrow. Your thoughts are on survival, surviving the storm. Banking reforms clean up a sector that desperately needed a cleanup. Minimum required capital was raised about 230% to 400 million. And a number of ailing banks were put under CBG, Consolidated Bank Ghana, to clean up the sector. It injected confidence and it created for a more robust pillar of the financial services industry. And people were happy about it. And yet, the investment industry is ailing. There are a number of factors for the malaise that we see in our industry today. I'll reel off about 3 or 4 of them. The first is an overstretched regulator. Our regulator is the Securities and Exchange Commission. And I think as of the last count, they had about 68 personnel. That includes drivers and secretaries. And when you have that number of staff monitoring and supervising a financial sprawl that's worth 30 billion, I mean, it's a recipe for trouble. The second is regulations that have not kept pace with economic reality. And what do I mean? At the last count again, the minimum required capital for investment firms in the country was 100,000 cedis. And I repeat that, 100,000 cedis. That's not much. But what that translated into was that it made a lot of small firms enter the industry. I think there are about 148 investment managers and advisors right now. And when you have so many firms chasing after the same piece of cake, it can only be a race to the bottom in terms of pricing, in terms of behavior. Third factor was poor governance and ethics. But I think we flogged that issue enough with the banks. So same thing as the investment sector. Throw in banking reforms to this mix of factors I've read out, and it could only be one outcome. And that's what we have here. We hesitate to use the word crisis in public, but we have a crisis in the industry. When you've guaranteed returns worth millions on 100,000 cedis worth of capital, and there's banking reforms and the bankers can't release the cash, there can be only one outcome. I'll reel off a few statistics. The SEC will confirm that from January to date, I think as of June, about 900 complaints have been lodged at their offices by investors who are looking for their cash. That compares to 500 for the whole of last year. So it's almost double the number. That 900,000 cedis, if you're quantifying it, is worth that 900 number, if you're quantifying it, is worth about 1 billion cedis. Now that billion worth of complaints is being managed by firms with total assets under management of about 10 billion cedis. That's a lot. More perspective here. The industry is worth 30 billion. So if you have, in quotes, Wahala with 10 billion, it means that 1 out of every 3 cedis is compromised. That's not fun. A bit more context. People don't realize that this industry is the fastest growing within the financial services industry. It's growing at 1.5 times the banking sector. What that means, and it's 30 billion, banking sector assets last count about 110 billion. What that means is that in the next few years, there'll be convergence. And you have an industry that will be playing an outsized role in financial intermediation in the country. And so that industry will have to be fixed. And that's why we're here. We are here to diagnose the ills of the investment services sector and shape behaviors, policies, and actions that will create pathways for growth for us. Because when you have a healthy investment industry, suppliers of capital can meet demand for capital and channel those resources for growth. And it also creates wealth outcomes for all of us here, for all actors in the economy. And so we hope that at the end of this 1.5 or so hours of deliberations, we would have gotten closer to that outcome. Welcome to Stanlib Dialogues 2019. Thank you.
Thank you very much, Alex. And I don't know how that went by way of context, but I believe it's given us a good place to stand from. So essentially, we're trying to find out what's happening with the investment sector. And of course, you know all this, but I just remind you, we know that the banking sector has gone through some challenge from 2017. And I'm sure by the time they read the midterm budget, you would know that we've spent over 10 billion cedis trying to clean that up. We also know that a few weeks ago, they announced something to do with microfinance, which is about 1 billion or so. And we also know that very soon, indeed, we've been told in an interview with some of the officials that there's something coming up for the savings and loans. So I think one of the key questions we want to ask ourselves is, where is the investment sector in this financial sector? Is there an equation somebody can draw and put the investment sector in there? Or can you show us a diagram as to where the investment sector is and how it relates to all of this? I think that's one key question I want answered. I don't know about you, but I want that question answered. I also want to know what Alex means by there's a storm. There are different kinds of wind movements, right? So there's a gale, there's a storm, there's a typhoon, there's a cyclone. Why is he calling it a storm? What does this storm comprise? So we want to understand what's happening with that sector. What numbers are we using? It's something we would like to understand. So if we conclude that there's a storm, is the storm self-inflicted or is a storm a borrowed storm? Clearly, we want to know whether it's the bank's cough that we have inherited the code from, or whether we have inflicted a storm on ourselves. So that's one question I want to answer. And then, of course, we'll look at what are the responses from the industry itself, from the regulatory side, and from other sides. So those are the questions I have. I don't know whether they are good enough questions. Are my panelists happy? The question's okay? Should I stick to those or I should add more? Okay, so who are our panelists? We're very blessed to have a very balanced panel. So we have the industry. We call it the GSIA. The GSIA. And our governing council member representing the industry is Miss Elsie Enninful-Adu. And her experience is over 20 years in this sector. And until June 2011, she was a GM and a senior partner at Fidelity Capital Partners. Prior to this, she worked as an investment banker with significant experience in the industry. And she also worked in strategic management, treasury, capital markets, and corporate advisory segments of investment banking. Her interests are in education, finance, healthcare, and corporate governance. And as I said, she serves on the governing council of the GSIA. Ladies and gentlemen, let's receive our first panel member, Miss Elsie Enninful-Adu, coming from the industry perspective. Since you go first, you choose where you sit. And then I would now have the MD CEO of the bank that we in the media look at. In fact, when they don't say something that we said, they've said it. And I'm not saying that to boast, but the truth is that a lot of people want to know how well this bank does, because a lot of people see it as the barometer for the success of the reforms. Because 5 banks were merged into one. It's probably the most difficult job in finance in Ghana. And this man, prior to his appointment, was running very big banks, indeed. Deputy MD UBA, MD UBA Tanzania, ED for First Atlantic Bank, where he worked to do some very interesting things. He's a chartered accountant by training with almost 2 decades experience. And as I said, he's now doing probably the second most difficult job in finance, certainly the most difficult job in banking in Ghana. He's the MD of CBG. Ladies and gentlemen, Mr. Daniel Wilson Addo. When I introduce you like that, it's to let you like me, so that when I ask you any question, you forgive me. Great. Now, we also have, this gentleman's role. We've been looking for him in the media, and we're not finding him now. We've caught him here. So, the banking supervision, we know, is a very key part of the central bank's organization. And the head of banking supervision, which really does what it says on the tin, is the man who's going to be on the panel as well. He's called Mr. Osei Gyasi. Please put your hands together for him. I don't have as much apport on you as I should, but as for you, we know what you do. Thank you for being here. And last but not least, the man who is the deputy MD or deputy DG of the regulator for the investment industry that we are going to talk about. And he is in the person of Mr. Paul Ababio. Paul, thank you for being here. So, just by way of the way to work, I'm going to repeat the questions, and basically to set a framework for the discussion. Miss Enninful-Adu will give us the industry context, the investment companies, the industry practitioners context. We are very interested in knowing from Mr. Addo how well things are going. A small situational report. You don't need to give us a whole balance sheet, but just an idea of how things are going since you started this very important job. And then the two regulators, as for you, you know what we'll ask you already. So you prepare yourself for that. So, but Elsie, are we in a storm? Because we know we in the media use a lot of terms very flippantly, and I'm coming to sit down. I don't know if you have a mic. Please test your mics. We use a lot of terms very flippantly. Storm, crisis, scandal, and those things. But Alex has captioned this a storm. That's serious. So, were we in a storm? Are we in a storm, financial storm? And if it's a storm, how long has it been going on? I just want your general views on what's been going on since 2017 till now, and whether that shake-up qualifies to be called a financial storm.
To answer your question, simply, I would say yes, we are in a storm. And we are in a storm because since 2017, there have been various events in the financial sector. A number of fund managers were unable to honor obligations to their clients. A number of fund managers made various investments in a variety of things, instruments, papers, etc. And then when you add on the effects of the code from the banking sector, if I can call it that, that seemed to compound the problems in the investment sector. I wouldn't say that the banking sector is the only reason why there are problems in the investment sector. Absolutely not. But definitely it does play a role. It does play a role because based on what happened in that sector, based on pronouncements from various parties, regulators, institutions within the industry, it caused some discomfort for the public at large. And I think with any institution, if all your clients, especially a financial institution, happen to want to take their investments with you, or even in the case of a bank, their deposits all at the same time, it creates chaos. And the institution will not be able to redeem it all at once, which is why they have liquidity provisions, liquid funds provisions, and all of that. And all of that is supposed to help the institution to be able to honor its obligations as and when they fall due. So if for whatever reason a significant number of clients happen to want to do withdrawals, if you can call it that, at the same time, it causes a run, if you can put it that way. And that will then result in panic, discomfort, and I think the effect of that has affected the financial sector as a whole. So yes.
So you will characterize it
storm
as a financial storm, not as a banking storm, but not certainly an economic. I'm trying to appropriate the size. So this is not banking, it's bigger than banking.
Yes,
but
absolutely.
it's financial, but it's not yet economic.
It's financial, but the financial sector plays a significant role in the economics. So the economy will have some impact as well.
I see. I say that to say that in 2007, the banking crisis quickly led to a financial crisis that then led to an economic recession. So those three followed. So in Ghana, we did have a banking storm. We are in a financial storm, but we don't know if it has translated yet. Or can we say that looking at what has happened, it's already led to an economic something?
I would say there is some impact on the economy. It may not be as significant, or we may not have measured it, so we don't have exact numbers, but definitely there is an impact on the economy.
Let me take comments on the panel on this point. Are we in a storm? And how do you characterize it? Is this just a banking storm? Is it financial storm? Is it economic? What's the size? Quick points. First, Daniel.
Yes, I think she said it all. It started as a financial storm, but the financial storm will always translate into an economic storm because of the fact that the financial system is inextricably woven into the whole economic structure. Right now, yes, we're not too sure the extent to which it has impacted the economy. And remember also that certain steps have been taken to minimize the effect on the overall economy.
Interesting. BOG, storm?
I wouldn't describe it as a storm.
I see.
From our perspective, we've had some challenges in the banking industry. But for some interventions, I think it would have resulted in a stormy situation. I think the appropriate steps were taken, and that has really calmed down. It has really.
So are we still on the sea, or we are at?
For now,
we've docked.
For now, we are almost about docking. Yes.
Really?
Yeah, because from where I sit, I think that we have come very far. But there's still some work to be done, and we need to finish the work. I see. So that we can see that we have finally docked.
So two things: it's a challenge and not a storm.
No,
and we are not in the eye of the storm now. We are getting nearer to shore.
We had some challenges, serious challenges.
Okay.
Which could have taken us to the abyss.
I see.
Yeah, but I think the interventions have been good.
Luckily, words like storm and challenge are English words, not financial terms. So we are at liberty. Paul, yes. What's your take on this first point? Where are we, and how do you describe it?
I think I'll bring geography into it.
Thank you.
Because when you talk about the banking sector, for instance, the mainstream banks, but you have SNL and microfinance. So depending on the location you're looking at, and the size, because I think if you look back maybe 3 years, the banks were reporting NPLs of around 25% average, which means 1 in 4 loans were bad. So it was getting to that crisis level, and as Osei mentioned, the steps taken have helped. Now when you come to the microfinance and SL, the question becomes how bad are their books? And what is the recovery rate that government can make out of that framework? So then the next phase becomes the intermediation side, which is my sector, the asset managers, investment banking. And there too, you'll find, as Alex mentioned, that you have this level of complaints, you have these assets, but not all the assets are in, I would say, unclear deals. Some of them are actually in government treasury bills. So even though the firm may be in distress, their holdings, once realized, may give some value. So it's still a crisis situation, and we are actually not in BAU, as one would say. So in a sense, I think I still see it as a storm. Mm-hmm. The effect on the economy, I mean, the loss of investor confidence. If you look at the stock market, trading has dropped significantly, down by 1/4. So, and that's a barometer. Normally, it's a sentimental measure. So there are sentimental views, but the quantitative elements, from our perspective, I would say even though the crisis looks big, it's actually some segment of the market, not the entire market, that is affected. And if certain measures are taken, we can control it.
That's actually a good entry into my second question. I was asking Alex whether he could put up a diagram that would explain the relative positions of the various players in the financial industry and the flows. So we have the banks, savings and loans, we have the microfinance, and then we have what you broadly characterize the investment sector, asset management, and investment banking. It would have been nice for somebody to explain to us in Ghana where the relationships are and where the flows are, to properly help us understand the timing of the crisis. Because it appeared to have started, at least the BOG intervention started with the banks, and for some reason they moved to microfinance, possibly because of liquidity issues, and they will go back to savings and loans. And while all this is going on, our investment brothers are struggling. So I would like one of you to explain to us what are the relationships and the flows, which affects which more, generic. We are not talking about what's happening now, generally. How is it supposed to work? Before we come to what's happening specifically. Is that a sensible question? Yes.
Let me make an attempt to just give you a gist of the issues. We are aware of the business of banks. What they do is to mobilize resources from surplus spenders, so to speak, those who have excess income. And what they do is to give out these monies they have mobilized out as loans. And a portion of the monies also may be put into investments. So what normally happens is that a portion of the investment could be in government securities. And banks also could also place some of the monies they have mobilized with SEC-related organizations as investments. And there's this interconnectedness. You could also have a situation where, because of the interconnectedness, you find a situation where SEC-regulated institutions also have monies with banks and SDI, savings and loans, microfinance, and finance houses. And you can also have a situation where microfinance institutions, finance houses, savings and loans have also mobilized resources from surplus spenders, so to speak, and they have also placed their resources with the banks. So from where we sit, we have a fair overview of the amount of monies that banks have with savings and loans companies, the amount of monies that banks have mobilized and placed with finance houses, the amount of monies banks have also mobilized and placed with SEC-regulated institutions, and vice versa. So that is the interconnectedness. So you have a situation where there's a bank failure or a bank has challenges. Then you say that you have liquidity challenge. You have to fall on your assets to pay the resources that you have mobilized from the public. And where are these assets? They are the loans and they are investments with the other institutions. Go and bring those monies. The monies are not forthcoming. Then you ask yourself, Nesikano Wahen. They tell you they are with SEC-regulated institutions. So I begin to ask my friend here. My institutions say the monies they mobilize, they place maybe 50%, 80%, or 30% with your institutions. So what is happening in your sector? Then he also comes back to tell me that my institutions are also saying they have resources with your sector. That is how it works. Then you ask yourself, can we set off? Because if you have placed with banks, and banks have also placed with SEC-regulated institutions, it should be a straightforward issue. But you go there, you set off, and you still realize that there are balances to be settled. And the same thing goes for the microfinance institutions with SEC-regulated institutions with banks. So you end up seeing that at the end of the day, the resources that the banks have mobilized, the resources that the SEC-regulated institutions and the microfinance institutions have mobilized, cannot be accounted for. Then the question is, could it be a situation where the banks, some of the banks placed with the seg-regulated institutions and the SDIs, they also placed with the banks, and for one reason or the other, the monies flew away?
So this thing you are describing,
this
thing you are describing, is it the same in all economies, or is in Ghana alone? Because it's almost like all play all. Everybody is dealing with everybody. It's not a flow.
Yeah,
it's a muddled network.
Yeah,
It's muddy.
It is supposed to be a very simple procedures if proper records are being kept and there's transparency and there's proper governance. Because at the end of the day, I'm keeping records of what I have with you, and you're also keeping records of what you have with me, and I'm keeping records of deposits that have mobilized. So at the end of the day, even if you want to set off, the balance should be zero, and there shouldn't be any outstanding issues. But if you have a situation where you have serious governance issues, you have a situation where proper records are not being kept, if you have a situation where there are related party transactions, monies are given out, and the monies are taken out, and they are not being accounted for, that is where you have the situation. And these are the situations that characterize the past.
Okay.
And this is the situation which brought us to the situation which we find ourselves now.
So just to be clear, you're saying it's not that the relationships are not clear, but if people are not playing by the rules, it
certainly
confuses things.
Yes, if people are not playing by the rules, and people are taking monies out and they are not accounting for the monies.
But are the rules clear? Are the rules clear?
Very clear. The banks will talk to you.
Panel members, anybody, are the rules clear? The rules are clear.
Yes, as far as the banking sector is concerned, the banks know the do's and the don'ts, and I think they even know it better than I do, because they have been in this business for years.
Great.
So if we are playing by the rules and we are keeping proper records and the governance issues are good, we shouldn't find our situation.
Great. We'll come back to governance issues. Yeah. And before substantive, because I just wanted a quick addendum to what you said. In describing the relationship, can you use the idea of size? So you have banks, savings and loans, microfinance, and then asset managers and investment. So if a bank is 10, typically, what should the optimum size of a savings and loan, the whole industry be? Because I'm thinking that the largest should be the banking in terms of assets, right? Or that relationship it doesn't follow?
Well, Bernard, I'm not sure there are any hard and fast rules around this. I think the key thing is that the different sectors work in unison to make the economy work and to keep the financial system safe. Now, if you have one part of it, as it were, not playing by the rules, then they create a problem that then moves on to the other part. So if the asset managers are not playing by the rule, or the banks are not playing by the rule, and it creates if you like, a systemic risk within their sector, because of the interconnectedness, it moves to the other sector. And that's what we've seen going around. Again, because there are placements and investments and deposits all around, it becomes murky. So it's difficult for one to have a bird's eye view over the total exposure within the entire financial sector. And that's been part of the problem. Like Osei said, we found, for instance, placements, interplacements across all the way. No proper records kept, so you can't go through and follow the trail. And that then makes it difficult to even spot a crisis when it begins to develop.
So having said that, move us into what you've been up to since you took over this most difficult banking job in Ghana. It's been a year, I think.
Great, Bernard. Yeah, it's been a year. Will be a year. Next week.
Happy birthday.
Yes, but it's been a very interesting year. Like you said, we took over, and I like to use the word storm again, but we took over in the midst of a storm. What we had sought to do was, if you like, to calm the storm. And I know that some people will not agree with the decisions that we took, but we did what we had to do because our mandate was clear. Our mandate was to protect depositors' interests. And to protect depositors' interests, we had to take certain hard decisions. So what have we done so far? We have actually, we took over 5-7 banks lately that were over bloated with staff, that had risk management and governance challenges. What we've done is actually to build the infrastructure for a high-performing bank going forward. So we've actually had to rationalize staff. We've actually had also to set up a strong risk management and governance framework within the bank. We've had to rationalize our branch network, and we've had to then move to begin to do business. Now, somewhere along the line, we took certain decisions, like I said, and now we are, if you like, optimizing what we've done. And so far, we've built a very strong and liquid balance sheet, and we are ready to play our part in this financial system.
So if you were giving yourself between 0 and 100, what percentage of the work have you finished in terms of what you were to correct? Where have you gotten to?
Bernard, that's a difficult question. We've done very well. I'd say that I'd give myself an A+, you know.
I thought you say, for example, that we had 10 people we owed and we've dealt with 9, so it's 1 left. What percentage? I wanted a
you
sense,
want numbers?
a sense of that.
Right. Let me just give you a few numbers, and I'll take the asset management firms as the basis. So we had about 1 billion cedis in deposits from asset management firms. About 700 of them have asked for their deposits, i.e., deposits have matured, and they want their money back. We've paid about 306 million out of that. The other half of that we're validating and double checking so we can make the payments. And there's another 300 million that haven't asked for their deposits at all. And the important thing to note is that that's an indication of confidence in CBG going forward. They've come to us and said, we want to do business with you, we're comfortable with you, and we'd like to keep our monies with you.
Brilliant. I'm not going to ask BOG what he thinks, because he will say, yes, you are doing the right thing. So I won't even ask you. What I want to find out is to go back to Alex and what he started with, and I'm coming back to Elsie. So now that we've understood this basic framework, what is really going on with the investment industry? What is really going on? Is it that your money is locked up somewhere? Is it that, just give me a sense, because he gave some numbers at the beginning. So tell us what is happening. Is it that you are broke, or your monies are just delaying in coming? Or is it that the SEC's new rules about investment changed the business model for you 4 years ago, for which we are now seeing the effect, if you get where I'm coming from? So what's really going on? Tell us in plain English.
I would say that it's probably a mix of all of them. Absolutely, fund management firms still have outstanding claims from banks, savings and loans, microfinance, and that would definitely assist in, I can't say calming, but reducing the winds that are blowing now. But apart from that, investments were also made by fund managers in a multiplicity of instruments, some of which may be acceptable and some of which may not be acceptable. In some cases as well, there's some related party investments, which could be questioned in a sense, the extent to which some of those exposures were made, and the question as to whether some of those assets can be recovered. So there's still a storm going on. Definitely, if there's a way to, or if we can address the obvious ones, which is exposures to banks, savings and loans, microfinance, which are all regulated by
You call them obvious ones. Drawing inspiration from NSMQ, what proportion of the problem is from the outstanding claims, and what proportion is self-inflicted based on bad behavior?
Well, I would say that a significant proportion could be bad behavior. Wow. That's from my point of view. A significant proportion could be bad behavior. I think when we look at it, it's from the basis of the perception of the run. So, like I said, if the obvious ones come into play, it will calm the storm. You see, because it's not just a current issue of bad behavior. It's also an issue of confidence. So a lot of the pressure and the reports to the regulator, etc., is because of confidence. People believe that if I don't take my money now, I may never get my money. And so it's not so much that they need it, but they need to have it because they want the safety and the comfort of the security, let me put it that way, of their funds. So that's really where the problem is from. And that's why we think that the obvious ones will still the wins, because then the reality is not everybody needs their money at the same time. So some people can have the ability to wait. But having said that, definitely there's a segment of bad behavior, and that is most likely where the challenge is going to come from.
It's very significant that you, from the industry, you are admitting before these noble people that a significant proportion could be bad behavior. And I saw Daniel heave a sigh of relief when you said that, because he was fearing you would say that it's because the banks, savings and loans.
It's because of CBG.
No, so I think that's a really important one. But now that you've said it, I wanted to ask you, you've mentioned related party, but it would be nice to give us an idea of what these dodgy investments, this bad behavior comprises. Give us examples. I'm saying this because I know that the SEC itself at some point directed that investment houses should stop guaranteeing return, for example. Could that be one of the behaviors that has brought us where we are?
Definitely, that didn't help. But that in itself, I would say, is not necessarily the whole problem, because guaranteeing returns basically only says that you will give somebody a specific return rather than giving them the results of the returns that you make on doing your prudent investments. So in itself, I wouldn't say it's the only problem. The problem is that when people guarantee returns, they then believe that they need to do all kinds of things to be able to justify or to be able to make the return, the promised return, or make good on the promised return. So that's probably where the problem is. So then the question is, what did that money get used for? So I wouldn't say the guaranteed returns is the problem. I mean, yes, we're not supposed to do guaranteed returns, but if those returns were, or if those investments were done in prudent instruments, they will be recoverable, or they are recoverable. So for example, if they were put in treasury bills, at some point in time, they will mature, so you can get it back. So the issue is not so much the guaranteed returns. The issue is what was the money used for.
So, thank you for that. Paul, I want you to come in. I'm still interested in the bad behavior, because if you want to solve a problem, you need to understand its manifestation. So from where you sit, what else were these guys doing, or are these guys doing, that has led them into this self-inflicted storm?
No, I think Elsie made a valid point that what are the investments they were doing? And it was interesting to hear Osei talk about the banks placing with asset management companies, because asset management companies, from a business model perspective, are supposed to be managing assets and managing securities. Now, if you have an asset, if you have an asset, so you have a house, it has to be registered in your name for your ownership to be complete. Then if you want to sell the house, you transfer the documents. Now, if you're an asset manager and you're managing assets, what is your hold on those assets? What legal claims do you have in the event of a default to realize those assets? So from a risk perspective, that's why we insist on securities, because securities are in general structured in a way that when you have to realize it, it's a little bit easier. And then the other dynamic becomes that if you are engaging in this fixed deposit return, you have to also invest somewhere. Now, if you are investing in assets that you have not perfected your interest in, and you're engaging in what amounts to lending activities, even before you talk about who are you lending to, let's say you're doing lending, a lending operation, you need a strong legal team, you need underwriters, you need a risk management profile, an investment committee. So those are at least 3 or 4 solid professionals in your team before you talk about the paperwork people, right? So, and then operations and systems. So if you are going into a certain business and that is not your area of licensing, even if it is legitimate, clearly you start to have challenges. So from that perspective, I mean, if we look at our data on those troubled firms we talk about 50% of their portfolio is to SMEs and other structured products, as they call it. And the challenge you might find there is that the structuring was not done properly. Because if you're lending to an SME, you're either giving them debt or equity. If it's debt, you lock it down. The banks won't give you money unless they've locked down your house, your mother, everything is tied. Right.
Is it that bad?
But if you are going in as a fund manager and you're going to give money to these people, then you're almost like doing private equity. It may be debt, but it's private debt. And private debt typically has a higher margin than bank debt. It is more punitive. It is more demanding. So they might have a coverage of, say, 150%. Because they know if things go down, they are the last people. The bank will get their money first. The SNLs will get their money before they come in as subordinated lenders. Because they're not even in that business as a licensed entity. So that's one dimension of it. So if you're doing private equity or private debt, then there's a category of business for that. And so what we are trying to do with this reform framework is to differentiate the business models. That if you are set up to, even if you want to mobilize bank deposits, then do money market instruments or do a money market fund. Because banks everywhere might do money markets. They need the money over 1 month, 3 months. But a portfolio manager can manage it with a certain structure and a certain transparency of securities that the bank may not want to lock themselves in.
Yeah.
So differentiating the models is critical. And part of that issue really is that differentiation.
All right. Unrelated example, when 7 hospitals turned away 1 patient, somebody famously said, if 1 hospital turns away somebody, that's bad behavior by a hospital. But if 7 hospitals turn away the person, that's industry practice, right? To give you an idea that you must differentiate between what errant people do and what is the industry norm. Using that premise, what proportion of the players within the sector you control were doing what you just described? Was it 1 or 2 bad boys? Or was this accepted practice within the industry that almost even the good guys thought was a good business to do? I know it's tough. Close your eyes and answer it. Some of them are sitting in front here. Don't look at them. Just look at me and talk to me.
Maybe if you go back 5 years ago, you might say that about 1 1/3 were in that realm. If you go back, because I think about 2014, so we came out with some of those frameworks.
So before that, about a third.
About a third.
In number. But in terms of size, because you can have a third, but that would be the top 4 people. So
Yeah.
I'm looking more at this.
No, when I talk about a third, I'm talking about the size.
The size.
The assets
Okay.
engaged there. But if you talk about the last, say, 3 years, overall, you could say a quarter of the exposure there. So there's been some movement.
Wow.
There's been some transition. And you find that some of those who were overexposed, for instance, if you look at, we've classified our portfolio accounts or our regulated entities into high risk, medium risk, and low risk. And it's part of our risk-based supervision framework that we're implementing. The high risk firms, you will find, have about 80% of their exposures in these other kinds of categories. Whereas the low risk firms, you find they have only 20% of their investments in these kinds of exposures. So we haven't done a trend analysis yet, but even on a static basis, you can see the direction and you can see what the risk parameters are. And the next question becomes, is there a correlation between the high risk? Because you could do high risk business if you have the high risk model. We don't say don't do high risk business. We're saying if you're doing high risk business, come out and say it's high risk. So if you look at the high risk businesses, they are the ones with most of the complaints. About 90% of the complaints are from the high risk portfolio names. right? So there is some correlation.
Yeah.
And it may not be the cause of it.
Yeah.
Maybe so that's
What
that's what we see in
is
the
troubling me
marketplace.
is that before you introduce your reforms, you said a third of the sector was behaving in that way, and after reforms, it's a fourth. So the behavior change hasn't been that quick. Could it be that your SEC is not fit for purpose? And sorry, you're a great guy. Obama is a lovely guy. But I'm saying, when I go to the Bank of Ghana and I see the number of people, the number of my mates who've done all kinds of degrees, who are sitting just in the veranda, in terms of the size of the organization, and they are rich. And then I come to SEC and I see some small room, 60 people, and I'm like, you people are very small. So could it be that even though you can be prescient to see what is going on, practically speaking, you are not built to regulate this very fast-growing, borrowing her words, industry, and that the regulatory framework is a very bad word, but I'll use it. The regulatory framework, we need to look at it again. Can you admit that?
It's something that we are looking at very seriously now. And as was mentioned, I mean, the entry requirements were low, but even then, our fee regime, a license currently is just about 1,000 cedis. We've revised it upwards. It's going through some processes, but for 1,000 cedis, you can get a license. That is very inadequate. And how do you resource a regulator with that level of income? What kind of resources are available? And in the past, we relied heavily on the market levies. But that makes Ghana uncompetitive, because if you are charging for every transaction, then the hurdle to trade has to be at least 5%. You have to almost mark up. If you have a share and you want to sell today, if you don't sell, if it's 100, you have to sell at 106 or 107. But 5% in a day is really high. And so we're looking at how do we diversify our revenue sources? How do we even restructure our business model? So we are looking at our organogram.
But you see, this question may not even have to do with you. So I'll pause. My question is an eagle eye question. Has the industry outgrown the way SEC is structured? Do we need a different regulatory framework for the whole sector? Some even talk about the Twin Peaks regulatory framework. I'm appealing to the people in the middle now. Do you feel that based on all we've said, we probably need a different regulatory approach to managing the investment sector? I keep calling you BOG. Forgive me, Mr. Osei Gyasi.
Let me speak to the banking industry. I think the regulator, Bank of Ghana, has responded positively with regards to what we have witnessed in the industry. We have always said that there were some challenges with respect to the supervision in time past. We have taken a second look at the regulatory framework, which forms the basis of the work that we do in supervision. And the regulatory framework touches on all the core activities that go on in the department, right from licensing, when the institutions are coming on board, where you could have serious challenges if the framework is not robust, because you end up licensing unqualified institutions. So that's, we have taken a look at it. Then another area is the way we do our on-site work. The way we do our on-site work, visit to the banks to look at the operations. We have also taken a second look at that in view of what we have gone through, and that also has been improved. And we have the off-site unit, which also receives returns from industry and do the analysis. But all these things that I have described would have to be done by people. And we have also observed that in time past, the people risk, the risk associated with the people who do the work, the risk was not properly managed. So we have also taken a second look at those in the department, the skill sets that they need, the cultural issues, the professional issues. And all these, it's like we've done self-assessment. We've done self-assessment of the department. And we have come to a conclusion that even though we have enhanced the regulatory framework, we think going forward it should be, we have to take a second look at
both
the
of you,
framework on an ongoing basis.
both of you are speaking about operational regulation.
Yeah.
I'm talking more about the philosophy behind regulation. Look, when there are crises in certain countries, they make major reforms. Which shake up institutions, merge institutions, and create new ones. Yes. Both of you are talking about how you work, which is operational. I'm talking about strategic. So the finance ministry, at the highest level, how do we regulate this sector that has brought us here? And how do we prevent that from happening again?
One of the weaknesses that we observe, I talked about interconnectedness, where you see the seg-regulated institutions placing with the banks and SDIs also placing with the seg-regulated institutions. There was a challenge because we did not have access to the seg-regulated institutions. Because Bank of Ghana was working as a standalone institution, and SEC and the pensions were also working as standalone institution. So at the strategic level, the question was, how do we ensure that we coordinate our efforts? Because we have a common objective of ensuring that the financial system is sound and robust. What it means is that at a certain level, let's say at management level, at the governance level, they should be talking to one another. Then besides that, they do supervision, we also do supervision. And insurance companies also do supervision. Are we working in isolation? Are they also working in isolation? Can we put up a system in such a way that when we are doing our work, we can leverage on whatever data they have and whatever information they have? What it means is that we have to coordinate and collaborate.
So as we speak, you don't do that?
As we speak,
you don't.
We have what we call the Financial Stability Council. And I'm sure you are aware.
When was the last time you met?
There's going to be a meeting tomorrow. We have met. There's going to be a meeting tomorrow. And the committee has been inaugurated. We have met. This is going to be the second time that we're going to
What's
meet.
the composition of that council?
The council, at the council level, the governor is there.
Man, chop hot.
So actually, there are 3 levels of this Stability Council. There's a working group, which one of the committees of that working group works on the granular regulatory collaboration in terms of inspections, in terms of assessing group risk. There are other ones. One of the pillars also looks at crisis and how we manage crisis. As we talked about, the crisis shows interrelatedness. So in terms of taking action, the action has to be coordinated. If you have money here and that person has money there, and then it comes back to you, can we net off? Does government have to put in 10 billion, or could their net amount be just 2 billion? Right. So there's that crisis coordination function. The next level is what we call a technical committee. And the technical committee consists of, I think Osei is on it. I'm also on that technical committee. And then NIC and PRA are also represented.
So which of the 3 are meeting tomorrow? Is it the
meeting
technical
tomorrow,
committee or the...
There's also a high-level committee.
No, Paul, I just wanted to know. He said they are meeting tomorrow. Which one is meeting tomorrow?
It's the high-level one. The high-level one consists of the heads of the institutions.
The big men.
The governors, the director generals, and the deputy minister of finance also sits.
And how often do they meet?
I think every quarter.
And what is their mandate?
Every quarter. So the primary mandate is financial stability. So they look at the financial sector, look at a broad range of interconnected issues, look at crisis, and then they actually report directly to the president.
So who chairs that organization?
The governor of the Bank of Ghana.
Okay. Yeah. I'm pushing because I just want to understand what is happening there.
But just to your point on so this Stability Council, there was actually a discussion held about a year ago about the regulatory framework. And some work was done on a Twin Peaks approach. Just that it takes time, and while you are in crisis, you can't be transforming the whole organizational framework. You can start to put the groundwork in place. You can start the interconnectedness, but what the consultants did was to even assess markets. And you find that people have what we have, and it still works. People have Twin Peaks, and some have changed from what we have to Twin Peaks, and it took them almost 5-6 years to get to that framework, and they still may have challenges. So it depends on how you actually implement whatever you put in place versus just putting in a new infrastructure.
Brilliant. I have a last question for the panel before I come to you, so I hope you have some questions. My last question, so the banks had trouble and we bailed them out. It's over 10 billion. Microfinance had trouble. We divided them into two, closed down half of them, and we say we'll bail out the 1 billion. Savings and loans have trouble. I know we will bail them out with at least 6 billion. I know this. So these investment guys who are in trouble, is that the solution we should expect? Or because, from her own admission, more of this was self-inflicted? This is not a kind of problem that requires a bailout. As for this question, I'll ask whoever wants to answer can answer. It's open to everybody.
I think let me. Yeah, it is right that there was an intervention and a new bank had to be formed to take on the deposits of the 5 banks. And depositors have been paid to a large extent, and the microfinance institutions to depositors are being paid. It's an ongoing process now. The SDIs, the savings and loans, and the finance houses, the regulator has indicated that that is going to be the last leg of the whole reforms. There will be some intervention as to when. It is only the Son of Man who knows. I cannot speak to the when. Yeah. But I can all say that it will happen. I want to believe that once the banking sector issues have been resolved, the microfinance and the savings and loans and the finance houses issues have been resolved to a large extent, it will also impact on the seg-regulated institutions because of the interconnectedness that we have spoken about. Because once settlements are being done,
so you are hoping?
Yeah. No, the data is available.
Because
I know
she
the
said,
extent, yes.
she just told us that the large chunk of the problem is the behavior, the self-inflicted. So my point is that
you see,
the amount of money owed them by the banking sector and all these people may not be significant enough to repair the hole they've created. So the fact that you are going to solve savings and loans and these guys, they may still be in big trouble.
I've said that we have the data. As we speak, I know the extent to which, I have the figures, I know the extent to which our institutions are exposed to their institutions. I have the net position. I know.
Are you prepared to share that with us?
Maybe in another forum. Yes.
After all,
and I have received a letter from SEC indicating their institutions and the balances for each institution. The balances.
Okay.
The balance that.
Okay.
There.
And when you compare the two,
and we have compared the two, and there's some more work to be done because we need to do a reconciliation of the numbers to ensure that when the time comes for payment to be made, the amount that will be finally paid represents what is really due for payment.
Paul, can you confirm or deny this?
Pardon me?
Paul, I'm just asking, is it true?
No, yes,
it's true.
It's true.
It's very true.
Yes. So I think along that lines, we've also looked at our industry. Part of it really would be the solution that we're looking at on the banking side, and we've engaged Minister on the same framework. But we're also looking at the other segment that you are referring to, and clearly that's a challenge. I think it's still work in progress. We've asked the industry for some data, and I think we'll be coming back to them. Obviously, to make some of these decisions,
one of the problems with you is that the BOG, when a bank is misbehaving, they let us know that the bank cannot exist in its present name. Microfinance, half of them disappear. So they basically don't just give you money, but they make sure that you are in a form that can survive. Your side, we haven't heard anything like that. They are all still talking. They are all still there. So my point is it that you don't have the information to decide that this guy cannot exist, so he should be taken over by somebody, or you are just looking at the people and they're also looking at you. That's my problem. Why are all of them still existent? If she admits that a lot of the problem is self-inflicted bad behavior, and you've also said that about a fourth of the industry post-reform is still misbehaving. We haven't seen one press statement that said, apart from these gold coin and these gang people, we don't even know, non-regulated people, properly regulated institutions, you haven't made any indicting press release on any of them. And yet we are sitting here saying we are in a storm. So please, I don't understand.
Yeah. No, I think there's a bit of sensitivity around it, in that our mandate is quite different, or how we intervene is quite different from what BOG does. We don't have the powers to take over and to do that receiver framework. Our receiver framework rests on corporate law, in that we would have to go through the courts for a receiver or liquidator to be appointed. Clearly, I mean, for some of these firms, we actually instructed them to halt new business. So that instruction actually went out. If you say they are still misbehaving, it's more about managing existing investments. Even if they halt business, that doesn't mean their obligations go away. And the portfolio, you've invested money in 20 companies. That portfolio remains outstanding. The key dimension becomes whether we revoke, and when we revoke, what actions do we take after that? If our intention is to protect investors, then the revocation decision has to be made very carefully. And you have to have in place a framework. You have to ascertain the client's base. You have to locate the funds. In the related party transaction, you have to trace all those funds. And a big part of our discussion with Minister is also that if there are clear issues of criminal behavior, we don't just want to revoke and liquidate, because liquidation might even take 2-3 years. But after you revoke and you liquidate, you also have to prosecute. We have to announce our findings. And these are very strong actions, and you don't take them lightly. You need to have your information. You need to have your case basically put together. But that's ongoing. As we speak now, we're actually doing forensic audits on some firms. About 21 firms are going through a process now.
Wow.
Mm.
And on the outcomes of that, we'll take certain actions.
Great.
from
Daniel,
there.
you've been very quiet, and I'm not comfortable with the way you are quiet. It's worrying me.
No, Bernard, let me just say I'm happy that it's come out clearly here that CBG is not the problem. We're not the ones. We're not the ones who have caused the issues in the fund management industry. I'm very happy. You know, I've tried not to say it, but
Everybody
it's come
has
out
said
very
it for you.
clearly.
Yes.
Absolutely.
Yeah.
But yes, I mean, moving on. Really, there are three aspects to it.
Yeah.
There are the fund managers themselves who have to get their act in order and begin to do the things that are right in terms of risk management, in terms of asset liability management, in terms of corporate governance, and the like.
Okay.
There's also the investing public who needs to move away from that mindset of chasing yields. You know, over the past few years, you know, to borrow Professor Sheila's words, there's been irrational exuberance. Everybody gets up and promise 25, 30%, and people chase after it.
Yeah.
You know, investors have to sit down and realize that there's always a trade-off between risk and return.
Yes,
And
sir.
if you go chasing return, then you must be prepared to take the risk and not sit down and wait for government to come and bail you out. You know, and that has to go down very strongly.
Great.
And I think that SEC and BOG has to keep pushing
Wow.
that across. It's
Brilliant.
very key.
Yeah.
You know, and then the fund management firms, of course, they need to go back to their clients and regain their trust. That's only how the industry will grow going forward.
And I think we need to commend Stanlib for this, because the mandate, in relation to the second thing you said, public education starts with this. So I hope you put this on air in some shape or form. We can't just have this as a group of financial tie-wearing people. But honestly, the people who need to be hearing these are the public, because the second point you made about and people don't understand all of these things, and they just go for returns and they end up in trouble. And I also want to say that a lot of these investment firms have seen their education mandate, and we are hearing a lot of them on radio talking more and more, educating people about what the do's and don'ts. And I think that's a very good clarion call. Please put your hands together for the panel. That's a great place to pause. Great place to pause. So now we want to take comments, and I need 2 mics, one here, one there. Tell us your name, where you work. If it's a question, who is it directed to? If it's a general comment, we're happy to take it, and we'll take it 3 in 10. We'll start from that side. Is that the man is already?
Hello, good morning. I'm called Larry Kwesi GIA. I don't know whether where I work is necessary, but I'll call myself an investor. And I also chair the board of a rural bank. And I sit on the board of ARB Bank. I sit on the board where we were told that you took a decision not to pay interest on investments by that organization. That is not an organization that will go chasing 30, 40%, a properly organized place. So if you sincerely think you are not the problem, you need to get back to those interested parties whose investments you inherited from the banks that presently form CBG. Because that is what we are told. Apart from that, some of the finance houses, you go to them, they tell you we have money with CBG. If they pay us, we'll pay you. I don't want to mention names, but if it becomes necessary, I know how to get you because I know your younger brother. I'll get your phone and call you. I used to be your younger brother's boss. I'll give you names, and I'll be very specific. The people who communicate to us are you're part of the problem. Now, I want to go to the regulators. The impression I got here is that you are not on top of your game. And that's where we are where we are now. The reality is, regulation is not a one-day thing. It's a continuum. Whether there were predecessors or not. We have always had regulation. And with all the institutions that I am involved with, either as a board member or as an investor, we always ask for their audited statements that you people pass. And now you are telling us, people know you have to invest. For example, I heard the Director General of SEC sometime on Joy FM telling us that people should realize when you go doing investment, there are risks. If I depend on you to take a decision, then at the tail end, you're telling us that we should realize that there are risks. I find it absolutely unacceptable. And there is the need for you people to do the coordination you're talking about. That should have been done 10 years ago, not now. 10 years ago, not now. Because you are part of the problem. It is you people who go for inspection. Bank of Ghana, SEC, you are the people who pass these institutions every year. I work in a rural banking sector. People's deposit 100 cedis. 1,000. Then they walk into your bank and you struggle to meet their demands. We are getting, especially the gentleman from Bank of Ghana, we are getting to a stage where the rural banks will start having people march into their offices. The earlier you people do something about this, the better. Some of the institutions tell us government owe them. And now somebody from the Ministry of Finance is here. And I'll mention one institution, NTAC. It's state-owned. It is not one of the finance houses. I tried taking 100,000 out from them last week. They can't pay me. And they tell me the Ministry of Finance owes them over 330 million. And you are the people who took the decision to regulate. Then you come here and try to push the blame on we the investors as if we don't know what we are doing. Some of us are very well informed. And we take our decision based on information provided by you people, either in your documentation or by you passing the accounts of these institutions. There's a lot you need to do before we start marching into your offices. Thank you very much.
Thank you.
All right, good morning. My name is Sylvia Inkum. I work with Stanlib Bank. To the regulators, I started thinking, so what's new? What's new? Because I have an auntie who suffered under Piram. I was much younger then, and I wasn't a banker then. And then I'm living today, and I am seeing all that is happening. And I'm wondering what is going to happen tomorrow. It's Mr. Dan Addo says that he's very happy that at least we have agreed today that it's not him and probably it's not the banks. But you see, if you restructure the banks and you don't work on the related parties, and as you spoke about the interrelations, I mean, if we were going to map that, it was going to be very funny how they are related. And when these issues happened, I listened to some of the complaints of the victims, and you find that some of them had actually taken good money and invested in bad places because there was an opportunity for arbitrage. If you give somebody a loan at 26 and he can make 30 a month, you don't call him irrational or gullible or greedy. There is an opportunity to arbitrage. To the regulators, how are you ensuring that you minimize that? It can't be a perfect market. But if there's such a huge opportunity to arbitrage, you don't accuse people that they are greedy, because the rational investor wants good returns. I like football, and I like sports, so I'll probably look at the sports angle. When people play football and somebody says the hand of God, but they have given the trophy already, and you can't do anything about it. FIFA said no. Let's introduce VAR. It stops you whilst you are playing. And we check, and we fix it, and we progress. You need a VAR. You can't wait after 5 years to do remedial stuff and then look for taxpayers' money to bail people out, only to do it again. Because I shudder to think that if we don't do anything decisive like a VAR, maybe 7, 10 years down the line, we'll have to stop the game and look for people's money to pay people. Again, nobody says that financial services sector players shouldn't make returns, but you must make reasonable returns. And again, athletics, IAAF, they want people to run, break the record. But if you run and they think you're running too much, they check your urine, they check your blood. So people cannot be returning on the market in a way that you know that, how are you able to do it? Unless you have some steroids or something. So when people are returning too much, you must stop them and say, guy, can we check your urine? Or can you stand? And in certain instances, you don't stop everybody. Allow everyone else who is running normally to run. But you can call somebody out and say, you stay, let's check your urine, whilst the others run. So it doesn't always have to be stop everything, let the music stop, let's see how many chairs we have, how many people don't have chairs, because we fix it. You can pull people out, the outliers, and allow the system to work. Once you do that, trust me, the system will find a way to converge. We may not fix it 100%, but we can minimize the anomalies, because I can't see anything happening the way we're going.
That was great. Well, okay.
Good morning. I'd just like to know when CBG will release their first financials. Thank you.
Good morning. My name is Natalie Apiajuma. I'm an associate lawyer at Osei and Partners. I had the privilege of working at the Financial Conduct Authority, which is the regulator for the banking sector in England. And if I'm to take perhaps some experience that I got from there, I would say that the banking sector, the financial sector, and also the investment sector have all been put under one umbrella. So we don't have a separate regulator for the investment sector. So my question to the panel is it about time that in Ghana we also adapt the model that is in England and perhaps in other jurisdictions where we decide to put together a Bank of Ghana and SEC? I think that perhaps if we were all in one building, sharing the same resources, having let's say, inter-party relations, the ability to bounce off each other. Perhaps that would be a step in the right direction. Thank you.
So I'm not too sure if all questions are supposed to be attempted. Alex, you need to help me here, because you have a rich number of questions. The simple one first, when I'm using your financial results, very simple. Merging the regulators, and then Sylvia using football analogy, the VAR, instead of stopping everybody, and then also the steroids. And then the first question.
So, thank you, Bernard. Let me deal with it in reverse order. Our financial statements will come out. The 2018 financial statements are almost ready, and our half year will also be published sometime latest by next week, first week in August. We've submitted the financials to Central Bank. They're reviewing, and we'll publish that. So that's it. Now, to Mr. Jage, you do need to realize that sometimes the fund managers or wherever you placed your money are not telling you the truth. So the next time somebody tells you he has money with CBG, come to me. Now, I say this because I've seen this all the time. SEC calls me and says, this fund manager says they have their money with you. What they fail to tell SEC or to tell their investors is that that same money has been pledged to about 3 or 4 different asset management firms and fund managers. You understand? So I first of all have to unravel the interconnectivity and then decide what the net amount due that fund manager is. And there are plenty of instances. Somebody has, say, 100 million with me, but 90 million of that is pledged out to other institutions. And then he fails to tell his investors that that is a situation. I'm going to get to a stage where I will start calling them out in public. That's what I'm going to do now. You know, because it's becoming irritating. They give us a bad name, and they've created a problem. Anytime somebody tells you that, come to me, and I call him out.
Let me add to what just Mr. Addo said. I've had instances where people have come to my office and they express the same sentiments that they had money with CBG. Then I started asking the questions, only to realize that the money was placed with a sister company of a bank, which CBG did not take over. I hope I'm making myself clear. If you place your money with an asset company of a bank, the assets and liabilities of those companies were not transferred to CBG. A lot of instances, management of the central bank directed that CBG should pay all deposits of rural banks and savings and loans and finance houses. So if you are here and you have money with CBG, rural bank, finance house, savings and loans, and you have not been paid, please come to my office. Because that instruction was given, and CBG is expected to comply. And for me, I have seen the numbers, what CBG has paid off so far. And if you still have a deposit with CBG and you're a finance company, savings and loans, whatever, rural bank, and you've not been paid, come. But please, if that money is encumbered, if you have used that money to take a facility, don't come. Yes, because they come to my office and you begin to ask the questions only to realize that the money is encumbered. They've used the money as a collateral to take money. Yet they go around telling people that they have their money with CBG. Then let me address the issue raised by Mr. Jackie. I appreciate what you are going through. But you see, if you look at the banking crisis all over the world, those who contributed, the regulators, external auditors, and board of directors, we've had very serious issues with some board members, the way they conducted themselves, and the kind of investment decisions they took. You have a company with net worth of about, let's say, 100 million. Then this company would take money and place with a microfinance with a net worth of 2 million. What kind of investment decision is this? And you have people sitting on these boards, and they knew what was going on, and they said nothing. Then at the end of the day, they come back and say that the regulator did not act. Meanwhile, they have also contributed to the situation. We are getting to a time where people who are not prepared to speak when the wrong things are being done will not sit on boards. And that signal has been sent. Mr. Jakwe, I see where you are coming from. Yeah, Mr. Gyasi, Gyasi, I see and I know where you are coming from. I'm not saying that those of us in Bank of Ghana, we are angels. I can tell you that speak to the banks and speak to the finance houses, and they will tell you what is going on now. I think those of us in the bank, the current management, everybody in the bank is difficult. Speak to them, and they'll give you the kind of feedback what they are going through now. We have also done an assessment of ourselves, and we are aware of what went wrong. Talk to the external auditors. The number of them we have taken to ICA Ghana and what they are going through. They bring their requests and we turn them down because we realize that you audited this bank over a number of years and you didn't say anything in your management report. You said everything was okay.
All right.
I've spoken to an external auditor who debited deposits and credited income, took deposits as profits. Where can you do this? So, Mr. Jackie, take it from me that on an ongoing basis, we are looking at the issues, and very soon we'll come out with the technology, the VAR. Yes, very soon we'll come out with it.
Right.
Thank you very much.
So there were two questions on the way you regulate, which the lady from the UK asked, which is also the second part of Mr. Diage's question about better coordination and whether the two of you need to get into the same building.
Thank you very much. These days, with the use of technology, you don't need to be in the same building.
I see.
So
you talk to each other.
Yes, with technology, you don't need to be in the same building.
All right.
But what you have to do is to deepen the level of collaboration and cooperation. Let me share this with you. Very soon, we will come out with what we call the consolidated supervision concept, where in supervising a bank or an institution, you look at the risk across the institution that you are supervising together with other sister companies, other related companies, because you can have a downstream risk and upstream risk.
I just have an observation which gives relevance to what Sylvia said. About 24 years ago, there was a body established called NPAT, Non-Performing Asset Recovery Trust, which followed the similar process that we are going through now. It has the same character. A bond was issued by Bank of Ghana to redeem the non-performing assets of government state-owned banks. I recall SSB, NCSSB before it was privatized, and some other government banks. At the end of the day, they set up a tribunal to recover those loans. It was never successful. This time around we have, in fact, those days it was special tribunal with a bond. This time we have the normal commercial bank going through the receiving process. When even we have a tribunal, it did not work. Now, a normal court process. Now, the similarities you realize is this. In those days, the banks involved were only government, state-owned banks. And when it happens, the multinational banks are not impacted. This time around as well, the multinational banks are not impacted. So where is the missing link? Regulators, Bank of Ghana comes to regulate, to supervise all the banks. They review their books. We have internal auditing of the banks. So you will see where the missing link is. Why is it that the Stanchas of this world, why is it that the Stanbics of this world, the Barclays of this world do not get impacted by all these? Because they have a head office supervision that comes in, and when it comes in, they go to the work. I can say here now, because I'm no more in the banking system, I can say freely that those days in Stanchart, when they tell you that Bank of Ghana is coming, we don't really take it as serious. Yeah, they will come, we'll do our work. But when they tell you that Stanchart London is coming for supervision, even when you are sick, you come to work. You know, so it is the missing, the Bank of Ghana probably is not up to their work. The auditors that are looking through the books are not up to their work. So we'll be here. 24 years ago, it happened, in part. The bonds were issued. Eventually, government is taxpayers who lost money. It has happened 24 years after that. I bet you it will not be even 24 years again. We will go through the same process. So I will put it to Bank of Ghana that there is something missing in their review process. Thank you.
Nobody here. Okay. Then let's go there. Then I'll come back later.
Thank you. Mine is more of an observation. And the question is that as I look at the panel, and we are talking about the financial services, quite clearly we've omitted one very important, young but vibrant one, which is the pensions industry. And I ask myself that in 2020, we are supposed to be paying out from the private sector, we're going to be paying out benefits. Now, is the contingent going to affect in 2020? Because if pension assets are also encumbered one way or the other, are we looking or waiting for 2020? I'm happy to see my regulator is here, but I would love to see him up there. So Stanlib, please take note that the pensions industry is very key, and as we go forward, that I believe is also key in some of these discussions. So just to highlight the fact that I'm also expecting my regulator up there to be able to be part of this. Sorry, my name is Joseph Ampofo. I work with Enterprise Trustees. Thank you.
Thank you. Any more questions? Okay, one here.
My question goes to CBG. In February this year, you met the fund managers. We agreed on some payment plan for those of us who need our money. And I must say, we are in July, we are going to August. CBG is still validating the claim. So I want to know whether that offer is still on the table.
CBG, you need to hold a press conference. Stop using our platform to answer your questions. Are there any more questions? No. Last question.
I want to just make this comment because it's come up, but I want to put a cap on it. We mentioned MPAT about 24 years ago. I can forecast, not because I know anything, but there'll be another financial crisis. It happens with every system. It goes up, it comes down, boom and bust. But what's unique about our situation is that it was quite systemic and mainstream. In every economy, you will find out that you have rogue elements. But in our case, it became mainstream. And we have a wicked problem. It's not wicked in the sense that we use wicked in Ghana. So, for example, how do we do audits? I mean, our own culture around audit. Even if you have a board, and we tend to say the issue is governance. I agree, but it's not wholly governance. Even if you have a board that's very active and working regularly, probably meeting every quarter, but Bank of Ghana goes in every month. How are they doing those audits? And what do they see? And that's what our CEO is talking about. The fact that he relied on these companies being regulated and the fact that they still were in the good books of the regulator. So it's important. And you started talking to some of the issues, how you've changed the way you do audit operationally. And so I want us to think about this very big picture as a nation. How do we correct some of the wrongs? Because it's a wicked problem, and it's not just financial services. It's something that we have and that has led us to this. It was the economy that led into finance and not the finance leading into economy. Thank you.
Mr. Kaba, I appreciate that you've left the banking industry, but I can assure you that you'll come back. Yes, because I've been seeing your CVs in my office. So.
Oh, Charlie.
Yeah, so I'm sure with
this,
your
this-
experience.
this is below the belt.
Yes. With your experience, I'm sure you come back. And we are looking forward to working with experienced people and well-qualified people like you. You can't sit home. You come back, certainly. So I'm looking forward to seeing you in the industry. Yes, I appreciate the issue you have raised, that the problem should be put at the doorstep of Bank of Ghana. And I want to rehash what I said. If you look at the challenges we've had all over the world, I'm not saying this to rationalize or to justify what has gone on in the bank. Supervisors have been indicted, external auditors, and board of directors, and even rating agencies have also been indicted. But let me tell you that the difference between the Stanchart, the Stanbic, the Barclays, the SG, and the indigenous banks that we have, the major difference is the governance issue. I'm telling you the truth. You see, on an ongoing basis, Bank of Ghana, Supervision, we don't manage the risk that the banks are exposed to. The decisions that you take on a daily basis, the strategy, the approvals, the role of the board, all put together, they are supposed to be managing the risk. So, if you have people, you look at their CVs, you look at their profiles, they are on these boards, and the wrong decisions are being taken. The wrong decisions are being taken on a daily basis, and they are exposing the institutions to very high risk. I told you about some of the things that we have seen. They know the rules. You collect people's deposits and give about 90% of the deposits to your related company. You collect people's deposits and go and buy land. And when people come that they want their money, you say, Brandon, trust as a man. What kind of decision is this? I have indicated that going forward, I think we have sent the signal. The signals have been sent. So when you bring your CV and it is turned down, when we begin to refer you to the fit and proper directive, the corporate governance directive, and we begin to publish the names, please don't come back and say that we have taken extreme positions, because we are going to respect the rules, we're going to enforce the rules, and those of us in supervision have always indicated that we're also going to ensure that we submit ourselves to whatever reviews that have to be done. If at the end of the day anybody falls foul before the law, the person would have to pay the price. And this is the signal that management, the regulator, has sent to the industry. So I'm saying that we accept the lapses that you have pointed out to us, but collectively we must know that we have a responsibility. And I keep saying that if you look at the industry, the greatest enemy of the industry, the educated elites, those of us who are educated, because at the end of the day, we take the decisions. And if you look at what has happened in the industry, at the end of the day, you can trace them to either Osei Gyasi, who is well qualified and should have known what he was doing, or Mr. Akaba, or Addo, or that person who should have known what he was doing. But the central bank, the regulator, is being blamed for everything.
Thank you. So there was a specific question to Mr. Addo. Somebody wants to know whether since February you've been doing verification, or is it validation? Validation, and is July you've not finished?
I don't know the particular circumstances of his issue. What I do know is that for those who have provided the documentation that we require to validate the deposits, we have paid. In February, when we met, we said we're going to pay 30% and keep paying until year end. We've subsequently moved to a position where we're paying out the entire thing once it has matured. So I don't know what your situation is. I can guess that you haven't provided every document that has been required. And we have to do this because we have found instances of, if you like, dodgy deposits. And so we treat everything on the same level and we double check everything. That's the only way we can ensure that the taxpayers' money is safeguarded in this situation. So you see me after this place and we'll have a look at it.
So Elsie and Paul, you have the final words. You've heard a lot of things. What are your closing comments?
I will start with the last CBG. I would say yes, the payments are ongoing, but no, it's not done. So I think, Daniel, you need to accept that it's a process. Most of it may have been done, but some still hasn't been done, not because there are issues, just because your process is your process. And I think, personally, I would say your process is slow. I agree that it should be done, but I think that you have challenges in there. Having said that, I totally agree with the linkage in the regulators. I think this has been spoken about for several years. I guess the question is how effective we are making it for the regulators to be able to discuss amongst each other and to be able to make decisions which is beneficial to the industry. And I would say, talking about the pensions regulator, the pensions are also linked to the fund managers. So once you have fund managers here, I think in a sense they can speak for them as well. The main thing I want to end with is really a point of ethics. I think if everyone was acting in the right way, and I'm talking across board, because I think the problems that have happened is really a collective problem. There were lapses on all sides, and so the blame should be shared equally. But having said that, I think it's a major issue with the ethics, because people may or may not be taking decisions with the right perspective in mind. Or most importantly, I think for all of us, our clients, our depositors are the most important constituency for us. And the question is whether we are taking decisions that are in their interest. And I think that for all of us as service providers, if we had that in our mind's eye with everything we did, we will be able to have a successful industry. And I think my final comment is, I would want to comment on the question that about the SEC's action. I think you asked that. I personally am with the regulator on this. I don't believe that jumping in to say, we've closed the firms down is enough. I think there has to be a total game plan before any such pronouncements are made. I mean, I personally believe that the Bank of Ghana's comments on the banks and the microfinance and then the savings and loans before the actions were taken, or rather before the funds were provided, is part of the reason why there's panic in the system, or there was panic in the system. And so I believe that it's not enough to just say firms have been shut down, but it has to come out with a comprehensive plan or what is going to be done before you come out with a pronouncement. Because we have to recognize that the current climate is that of uncertainty, confidence, and it's important that we don't make it any worse than it already is. Okay. And the reality, talking about the storm, is really the fact that it's going to take us a while to rebuild and to get out of it. So we have to be cognizant of that in everything that we do.
Thank you very much. And then we'll take Paul's final comments. Please, can you bring back the pulpit? We have 2 closing statements. Whoever has the pulpit, yes. Paul.
Okay. No, I think it's been a good interaction. We've also learned. I mean, we've learned from Bank of Ghana, and so that's informing our approach. We've also learned from the industry. I think about 2 weeks ago, we called the fund managers together to hear their views. We received only 2 submissions. So part of the issue, and maybe I'll just split it into 2. One is on the ethical side, there's also the need for risk management, sort of better professional risk management. Now, there are rules, but rules don't tell you how to conduct yourself in an industry. So like Bank of Ghana, we're also implementing a fit and proper test. Now, our background search, we're going to look at social media exposure, your credit history, it's going to go much deeper and much more intrusive, because these are people being entrusted with fiduciary responsibilities. So being clear on who are these people, how are they running their business, what's going on in the business, what are their ethical positions. If we see sort of 90% of your assets with one counterparty, red flags should go up. We don't run your business for you, but we expect to see certain attitudes or certain behaviors coming out of that. The other element is really the role of the industry. And part of financial services is really intermediation. That is allocation of capital from those who need the resources to those who have the excess resources for some fee. That intermediation, from what we are seeing, has not worked well. And I think that's where cycles come in. When you have oversupply of money, or it's easy to get your hands on money, people get it and then do, I would say, maybe not the best projects with those resources. So then that's why there's a need to coordinate. If Bank of Ghana is going to ease the supply of money, they may expect more liquidity. And when more liquidity is in the market, how do fund managers operate? Which means that there might be higher risk. Even though it's a looser environment, the risk might be heightened. Or if there's a tightening environment, then demand for money is also higher. Rates are going to go up. And if rates go to 25%, we should expect a higher default environment. Risks profiles will change. And so we can also adjust our regulatory lens and our assessment of regulated entities based on the economic environment we are in. I'll just touch briefly on the comment about what is different this time. Back then, the sums we were talking about were small. Now we're talking about billions, and it's a very big economy. You find individual investors with significant sums of money. And so there's more wealth. There's a greater portion of the population affected. Back then, you were talking about maybe 1% of the population who had bank accounts. Now you're talking about 30%, 40% in microfinance and banking. You add asset managers, you're getting to almost 50%. So there's greater access. The question becomes, how do we transform that access into greater intermediation? How do we ensure that monetary policy decisions translate into real growth, not just for the large expatriate firms, but for the local businesses as well? How does SMEs access credit? How do they bring instruments on the market? So part of our approach really is to encourage these diversifications and this transmission of credit in the system. So I think that's where the interaction should lead to.
Thank
next.
you. Put your hands together for the panel. Paul Ababio, Daniel, Addo, Elsie, Enninful-Adu, and my friend from BOG, whose name cannot stick in my head, Mr. Osei, Gyasi. Put your hands together for them. Brilliant. So we just have two things. We have some refreshments for you at the end, but we're going to take the closing remarks from Kwabna Buama. Kwabna Buama, put your hands together for him. You were supposed to be on air yesterday. You didn't come.
I was afraid of your questions. Good morning once again. I believe that today's discussion has opened another dimension on the banking crisis. Others call it the banking tsunami. But more importantly, highlighted another aspect that most of us probably haven't looked at critically, and that is the asset management industry. And I guess the debate will continue even after this event. Our whole idea of having Stanlib Dialogues is that when the debate continues, we will focus on the way forward. We will, yes, wail about the past effects, but it's our hope that as we move out of here, we will focus on what are the way forwards to address these challenges that we have seen in the industry. I believe one of the key takeaways today is that the financial sector is heavily interconnected. You talk about the banks, you talk about the asset management firms, savings and loans, microfinance institutions. Hence, the need to have a collaborated and a holistic approach to supervision and regulation in the financial sector. And I believe our panel have done justice to this observation. It's our hope that as we leave here, and as the BOG rep said, tomorrow's meeting will seriously deliberate on the interconnectivity as well as the holistic approach to our supervision. In our midst this morning, we have trustees, investors, industry partners, players, seasoned industry practitioners, bankers, and other professionals. And we're grateful for your presence. We hope to see you again in the year 2020 for another dialogue. Hopefully this time it won't be surviving the storm, but probably power gliding a robust industry. Thank you for coming.
Thank you so much, Governor.